Well, great. Well, thank you, Tara. Good afternoon, everyone. As Tara said, thank you for joining us today on our New York tax update. Today, we wanted to touch on some of the areas that we see some, frequent questions and concerns when it comes to New York. So, hopefully, maybe some of you have been with us when some of our other states presentations. We have the same presenters today. So we have Laura Robichaud, State SALT Senior Manager out of our Phoenix office. Stacy Roberts is our SALT Senior Manager out of our Denver office. And I'm Jennifer Edwards, a SALT Manager out of the Sioux Falls office. So just to get started, kind of give a quick overview of what we'll be talking about today. I'm going to start off by talking about just doing business and NEXUS kind of in general, and what does that mean, and how are those terms defined. Then we'll discuss a little bit about registering for a business for sales tax purposes in New York, who needs to register and when. After that, Laura will take us into the world of sales tax. She'll delve a little bit more into determining sales tax nexus in New York. She'll also discuss what is and isn't taxable and the sourcing rules for sales tax purposes. And then she will also touch on some recent rulings to be considered for sales tax purposes. After that, then Stacey will move into income tax and do some income tax discussion. She will, again, go a little bit more and further in depth into Nexus and doing business in New York for income tax purposes, and then also touch on combined reporting, apportionment, the taxes that are imposed on pass-through entities. And then I will just wrap it up with just a quick overview of steps that need to be done in order to close out a registration in New York if you have registered to do business and are no longer going to be conducting business or active in the state. All right, so with that, I'm going to move right into doing business in New York. So just quickly, Nexus and doing business. Those are terms we hear frequently. Really, Nexus is the technical term, and that's the sufficient connection that's needed with a state in order to subject an entity to the state, the tax laws of that state. The amount of activity in or connection to a state that's needed to establish Nexus, that's basically, it's defined by state statutes, regulations, and case law. As such, the definition can vary from state to state. Still, a lot of times when we're talking about does a state have to, or entity have to register, or are they subject to the state tax laws in that state, states use broad terms such as doing business in or deriving income from to describe the connection that's necessary to establish that nexus and create tax filing requirements. Those broad terms, however, are usually not very clearly defined by the states. So it really is up to the taxpayer, the business, to make some interpretations, figure out if what they're doing, if they do believe they've met that threshold. So for sales tax nexus standards, the general standard is physical presence. And when you think of physical presence, it would be the obvious things, such as having an employee in a state, having an office in a state, using independent contractors or inventory in the state. So that still is the general standard, physical presence. Even though other states, there's been a number of states over the last couple of years that are looking to find ways to subject more out-of-state, remote sellers to their tax laws. So some states have looked at putting in place economic presence rules on the sales tax side. Fortunately or unfortunately, at this point, none of those economic nexus rules are really in effect. But just last week, there was the South Dakota versus Wayfair case that was heard by the U.S. Supreme Court. So we'll kind of just have to wait and see what comes of that. But as of now, physical presence is the general standard from a sales and use tax perspective. So in addition to physical presence, New York itself also has a click-through nexus, as do some other states. And the click-through nexus for New York is really a presumption that certain sellers of tangible personal property or services are vendors, and they must then be registered, or they're required to register for sales tax purposes. So to meet that presumption that the seller, or it's presumed that the seller is a vendor, and they're required to register and collect and remit New York sales tax if they have entered into an agreement with a New York resident for which commission is received by the resident for directly or indirectly referring potential customers to the seller's website. And if the cumulative gross receipts by the seller to New York customers resulting from those referrals are more than $10,000 during the preceding 4 quarterly sales tax periods. So even with that click-through nexus, there still is an element of physical presence by having that New York resident in the state. New York also has affiliate nexus, and that is under certain circumstances, the definition of a vendor would include a remote out-of-state sellers that are affiliated with business entities in New York. The out-of-state seller and a New York business are considered affiliated if one owns directly or indirectly more than 5% of the other, or if more than 5% of both of the entities are owned directly or indirectly by the same person or an affiliated group of persons. So again, even though it's an out-of-state vendor, there would still be an element of physical presence by being affiliated or related to an in-state business. Income tax nexus standards. Some states, many states actually, think there's a lower threshold for income tax standard than for sales tax. So although physical presence in a state would, in most cases create nexus for income, franchise, and gross receipts tax, many states have adopted an economic presence, thus saying you don't even have to have physical presence in our state in order to be subject to our income, franchise, and gross receipts taxes. And how the states define that economic presence, in many ways, it can vary from state to state, but in general, it's really, the states say if a business has an economic presence, or it's their economic connection with the state. So if they've made a market, if they have any type of financial gain or benefit from the state, then the states are saying that that would be enough to create an economic presence in the state and subject them to that state's taxes. Then some states have gone a little further, and New York is one of those states that have actually established a factor-based threshold, so a bright line test, so to speak. And that would be that there's a actual factor, a bright line that would say if you've reached this threshold, that is what creates nexus, or you have created nexus or established nexus and would have a filing requirement. So effective in 2015, New York established a $1 million sales threshold as their bright line test. So who needs to register and for a tax certificate of authority and to collect and remit sales tax in New York? So the general rule in New York is if you are a vendor and you are selling taxable products or taxable services in New York, and you have any of the following, you would have a requirement to be registered. If you maintain a place of business in the state, solicit business from through employees, independent contractors, or other representatives in the state. If you solicit business through catalogs or other advertising material and have another connection with the state, or if you make sales of taxable products to New York customers and regularly, which regularly the state defines as at least 12 times per year, deliver products in a company vehicle. So as you can see, in all these, there is an element of physical presence, so that's key. But in addition to that, if in order to be able to accept or issue New York sales tax exemptions, you do also have to be registered with the New York Department of Taxation. So how about for out-of-state businesses? Out-of-state businesses have really generally the same rules as far as somewhat of a physical presence. If you're delivering products, taxable products into the state at least 12 times a year, solicit through employees or independent agents that are located in the state or visit the state, and then also going through catalogs, other advertising material, and having a presence in the state. In addition to that, if you, as we mentioned earlier, when we talk about affiliate nexus, if you are an out-of-state business and you are affiliated with a New York entity, that then you could be considered a vendor and also have a requirement to register in the state. So, and just one thing that I want to mention when we're talking about this, it truly is the state's looking at your physical presence, but also what is it that you're selling. It has to be a taxable service or product. So for example, if you come into the state and sell at a craft fair for a short period of time, and what you're selling is tangible and it's a taxable product in the state, you would be required to register for sales tax in New York and collect and remit the tax. However, if you come into the state and open an office and you're going to be providing accounting services in the state, you wouldn't necessarily be required to register for sales tax purposes because the service that you're providing is not taxable. So again, even if you're physical presence element, but not the taxable service part. So you have to have both to have the requirement to register. And Laura will talk more about examples of things that are taxable services and products, but these are just kind of some general ideas. Basically, taxable products, tangible personal property, things you can feel, touch, see. Taxable services, installing, repairing, maintaining, servicing, tangible personal property, computer repairs, services that really are connected with a tangible item. So once it has been determined that you're doing business, you have a requirement to be registered, what do you need to do? Well, first of all, you should register at least 20 days before beginning business in the state of New York. There are penalties for operating without being registered, so it's really important to register ahead of time, before you actually start doing business. Apply for the sales tax certificate through the Department of Taxation and Finance. There are two types of certificates of authority in New York. There's the regular and the temporary. Regular would just be what we think of. There's no starting and stopping point. It's just for the duration of your activities in the state. Whereas temporary, those permits or those certificates of authority have a beginning date and an ending date. So depending upon the duration of your service or activity in the state is what would determine that. But one thing to keep in mind that if you're in, if your business is something in a show or entertainment type line of business, even if you're only in the state for a short period of time, say coming in for a craft show or an antique show for a short period of time, the state does require you to apply for the regular certificate and not the temporary. And as I mentioned, there are penalties for failing to register, and the maximum penalty for operating without a valid certificate of authority is $10,000. That is imposed at a rate of $500 for the first day with operating without a valid certificate of authority, and then $200 for each day after that. So they can be kind of some significant penalties, so it's definitely something to keep in mind. And then New York also has other types of business permits and fees that may be applicable depending on the type of business or industry that you're in. But for the purposes of this presentation, we're focusing on the sales and use tax and income tax requirements. So with that will take us to our first polling question. When is an entity required to be registered with a New York tax department and obtain a certificate of authority? When they sell tangible personal property once a year at a craft fair, if they contract with independent agents from New York State to facilitate taxable sales, if they accept sales tax certificates from customers in New York State, or all of the above. All right. Well, great. Looks like you got the majority got it right. The answer would be all of the above. So, all right, thank you. And with that, I will turn it over to Laura.
Can you hear me okay? Thanks, Jennifer. So what I'm going to talk about is sales tax within New York. Now, Jennifer touched on some pretty high level, this is what determines NEXUS for sales tax and then also for income tax. But my focus is actually going to be specifically on services, because I think that the taxability of tangible personal property is pretty straightforward. Where things kind of get gray is, I provide this service or software in a service. I don't really think that's taxable. So I'm going to talk a little bit about that. And then I do have a couple of interesting cases that I'm going to go through with everyone. If I can get this to move forward. Okay, there we go. So to piggyback on what Jennifer said, obviously if you're selling taxable items, specifically what we call TPP, which is tangible personal property, in New York, that would give you NEXUS. If you happen to be one of those vendors that's delivering, like a repair part, and maybe you're just the company that goes in and, does the repair, or you're the one hiring someone who's local because maybe you don't have a person there to fix the repair, that would automatically give you NEXUS. New York is probably a little bit more of one of the more aggressive states where they have this new reporting requirement for those of you that sell any of your property online. So for example, I physically sit in Arizona. Let's say, I've got a great online business, all my inventory's here, I've got everything in a warehouse here, nothing actually goes into New York except for when somebody purchases something from me. So you can see the bottom kind of little block there. It talks about internet sales that are from someone clicking on my website and I fulfill an order. And this can kind of get tricky because $10,000 really isn't a lot of money, but what you don't realize is New York is one of many states that has this reporting requirement. So let's say, you ship one thing and it's $15,000. Well, New York would come back and say, well, that one invoice for $15,000, because I'm a manufacturer, now I have NEXUS in New York and I have to file. So you kind of have to be careful, especially if you're one of those companies that tends to maybe go into a state. I would say you're probably going to be okay if you're going maybe once, you went into the state once. Yes, it would technically give you NEXUS, but that might be a one-off situation. But if you find that as your business is growing, and you're starting to expand into different markets, if you're noticing that you're having higher sales or more frequent sales in New York City or New York State, you may want to look at, because you probably have created NEXUS somehow. So for what's taxable and what's not taxable, obviously, anything that's tangible personal property is going to be taxable. New York, especially New York City, has that caveat for those of you that do have or have ever shopped in New York City. Some of the clothing or footwear is it's going to be exempt. It's not subject to tax, but only up to a certain amount, and that's per item. Any type of plumbing, electrical repairs, even removal services are going to be taxable, as New York is one of the few states that does tax services. But also, just like with all the other states, they have several exemptions. Anything that's prescription is going to be, especially prescription medication, and even some levels of medical devices or durable medical equipment are going to be exempt. Obviously, any sales to nonprofits are going to be exempt. So as long as you have documentation to support that exemption, then you're fine from an audit standpoint. But just because somebody says, oh, we're a nonprofit, that doesn't necessarily mean that they're exempt from sales tax. They actually have to provide some sort of information that proves that they are. So sourcing, this is one of the ones that kind of trips everyone up a little bit. So there's two different types of sourcing in the sales tax world. There's origin and destination based. So origin is your sales tax rate is going to be dependent on where you're shipping from, and then destination is going to be based upon where you're shipping to. And New York is actually a destination-based state. So you could be in upstate New York, like Saratoga, and if you're shipping something into New York City, then you need to apply the New York City sales tax rate, because you're going to apply your sales tax rate on ship to, not ship from. And this is kind of confusing for a lot of clients, especially if you're in a state that is, you're used to charging your sales tax based off of, well, our location is, you know, in Phoenix, Arizona, so I'm going to charge the Phoenix, Arizona rate. Well, that's not actually accurate. So that's one thing that for those of you that do ship in products or even services, you're going to want to do that off of where the customer's location is, or where that actually that service is occurring. So that can be tricky. Unfortunately, if you don't really have a sophisticated system, it can get really messy because you have different rates, and rates can change. So if you're doing a lot of ship tos, then you're going to have to keep track of all those things. Eide Bailly, as a firm, we partner with Avalara, and Avalara is one of the great software systems that helps clients in this type of situation where you realize, oh my gosh, you know, we're a manufacturer and we're shipping stuff all over the place and I can't keep track of this. Software like Avalara would be able to help determine those rates and keep them updated so you wouldn't have to worry about it. So if you find that you are growing, I would really strongly suggest that you reach out to whoever your accounting advisor is to talk about, you know, maybe we can put some automation into this, because too many Band-Aids, it becomes a nightmare down the road, just from personal experience. So that's pretty much the sourcing. Just so New York is destination and they're not origin. Everything is based off of ship to. Okay, so here's two what I would think kind of landmark or milestone rulings. They're actually called advisory opinions. So New York, like all of the other states, have allowed for taxpayers to write into the department about questions, and then the department has a specific amount of time to respond. So if I had a question, let's say I sell a durable medical equipment product or device, and I don't know if it's taxable in New York because my company is based on the West Coast, you could write in to the New York Department of Revenue or Taxation, and then they would provide you a response based off the facts that you provided them. So they're somewhat binding, but they are a case-by-case basis. So the two examples I'm going to go through are different companies that wrote in to New York and said, hey, this is what we're doing. Are we taxable? It's great if you're planning on expanding in New York, or you're getting ready to absorb another company that happens to be located in New York. And this way you kind of, you have some basis of information. But again, it's really dependent upon the information you provide them, because one little piece of data could absolutely change the outcome of whether what you're doing or selling is taxable or not. So in this situation, the Department of Taxation and Finance in New York, they received a letter from this software training company. So this company, they delivered interactive training programs. They had customers that had locations in New York, but those same customers also had locations out of state. They had a product code. So this is a software company. They had a product code, it was called Skinned for retailers. So in this advisory opinion, they were describing the quote unquote skinning as the customizing of the core code within their customers' network that reflected the logo, reflected the name, and also they helped with pre-recording like training products for their clients. So a lot of you probably have like an HR department that, has these wonderful pre-recorded training videos. This company did something very similar to that, except they also wrote the code behind it, so it was a little bit more interactive. So this company charged their clients for this quote unquote pre-written software. Also, it was essentially an app. So they charged them for the pre-written software, and they charged them for the creation of the media programs, the training videos. Their billing, and this is the part that really becomes crucial when it comes to taxability. So this company kind of bundled in their billing, so they would, they did $15,000 worth of service, and it could have been 4 different things. Well, they put it all on one line. That is never a good idea in like any billing situation. I would highly recommend that you break everything out on your invoice if you can, because if you don't, then the state might view the whole thing as taxable, which is kind of what happened here. So because they didn't break out the billing, New York said, well, if you can't break out the bundled stuff, that becomes taxable. But the part that got this company, well, some of their activities were not taxable. New York said, because you have a subscription fee and your customers pay you a monthly fixed fee to use your software, even though part of it was canned, it's considered taxable. So the parts where they modified for each customer, that was exempt as long as they could break it out. But it was the subscription fee that caused them to be like, oh no, okay, this is now taxable, what are we going to do? And a lot of companies, especially the tech companies, add a subscription fee because it's a revenue generator, and it's a bonus for the customers, because within that fee, they might have like 24/7 phone support or whatever the case may be. So the reason I wanted to bring this up and thought this would be a really good case or advisory opinion to share is that there is this misconception in the IT industry that I noticed is probably a little bit more lately than normal, that the business of what they're doing is not subject to tax. And what we're seeing across multiple states, including New York, is that any type of software as a service is becoming taxable. So right now, there's about 16 states that tax software as a service. And anything that you custom do specifically just for one customer, that's not going to be taxable. But anything that you're doing that's what they call canned software instead of custom, that's going to be taxable. So you kind of have to really, if I were to give any advice, I would say understand everything that you're doing, break it out into different buckets, and then look at each of those things to determine whether it's taxable or not. Because in software as a service, this company is a great example. They were writing code, they had canned software, they did bulk billing, and they had a subscription fee. So that was just one example. And then my last example is another tech company. They're actually a pretty large telecommunications firm. And what they did is they also wrote into the New York department, and they wanted to find out, okay, we're offering these online solutions for software, basically VoIP, which is voice over internet protocol, and we don't know if we're taxable. The reason why is every single thing they did was outside of New York. They didn't have servers in New York. They didn't have people in New York. Nothing. All they had was the customers that were using their quote unquote service on servers that were not in New York. And I thought it would be good because, a lot of times, we, as businesses evolving, a lot of stuff is being put up in the cloud, and everything that's in the cloud or stored in the cloud has to be accessed somehow. So in this advisory opinion, the company, their customers don't download everything. It's just like your email. You type in your password and you log in. So their product doesn't really move. It just is the service of moving messages. So, like web conferencing and, you know, telefund, webinars like what we're all on right now. That is kind of what they were trying to find is, all right, well, we charge a startup fee. We kind of charge for storage charges or any changes they want us to make to their system. We kind of charge for that, but we don't really think we have NEXUS because we don't really go in New York and we just have customers there. Well, New York had a different way of putting it. They said that all of the license fees were taxable as pre-written software, even though that software was never downloaded. So that was kind of epic. And then also the startup fees were not taxable because they were associated with like some of the custom software. But if the startup fee was not associated with the custom software, that became taxable. So just an interesting case that I thought was, you know, it all goes back down to how are you breaking out your billing, and then what are you doing? Even the little thing between custom software versus pre-written software makes a difference. So that's kind of the summary for that. And I'm going to pass it over to Stacy in our Denver office, and she's going to go over the income tax side for New York.
Thanks, Laura. So yeah, I'm going to change gears here for a few moments and talk about income tax in New York. And some of you might be aware of New York income taxation, and that it has in recent years, well, previously had been a little bit more complicated. A few years ago, they did enact some legislation and change some things where they tried to make it a little bit more uncomplicated. However, they do still have some nuances in their tax law and some things that we just wanted to make sure we highlighted for everybody today. So first and foremost, what is income tax nexus? Jennifer had touched on this earlier. But from an administrative and policy standpoint, New York says that taxpayers have income tax nexus if they are doing business in New York, which we'll talk about a little bit more what that means. If they maintain an office in New York, if they're owning or leasing property in New York, if they're employing capital in New York, and we'll talk a little bit more about what that means too, or if they're deriving receipts from activity in New York, and we'll talk more about that too. So, what is doing business? So from an administrative standpoint, what they determine as doing business, and these are just some examples and some things that they will take into consideration for taxpayers, but basically they're going to look and see what's the nature and frequency of the activities in the state, why was the corporation organized, and the location of the corporation's offices and other places of business. They're going to look to see if there's an employment of agents, officers, employees in the state, and then the actual seat of management. So basically, they're looking at the company's activities as a whole and not just a few activities on their own. Then what's employing capital? Well, it is basically, as it sounds, it is basically using assets in the state, and that can mean maintaining raw materials and inventories in the state, or owning materials and equipment that's assembled for construction in the state. And then, as I mentioned before, too, there's the deriving receipts, which goes back to what Jennifer had mentioned early on about factor presence. And so that bright line test that New York has is where they say that if you have receipts of $1 million or more in the taxable year, then receipts of $1 million or more in New York in the taxable year, then you'd have nexus in New York. They do have some special rules for credit card issuers. As you can imagine, with New York being quite a financial hot place, credit card issuers have a lot of customers in New York. So they've put some rules around credit card issuers and the fact that they could have some different nexus standards. But I do want to highlight the last bullet here with respect to the $1 million of receipts, because we have a situation where we could have a single taxpayer that would exceed the $1 million, and that's one thing. However, what if you have a group of taxpayers that file a combined return in New York, which we will talk more about what that is, but the way that New York employs that $1 million rule is that if you have a corporation that's part of a combined group and that corporation has between $10,000 and $1 million of receipts in New York, then they look to all of the members of the group to determine whether they will in total meet or exceed the $1 million threshold on a combined basis to determine the nexus. So that's some of the nexus drivers. I just want to highlight here on the factor presence and the fact that we've got this $1 million threshold. Suffice it to say that that is one test. And so if you have, capital in the state, like I mentioned, employing capital and some of the other physical presence standards, then this $1 million threshold, I wouldn't hang your hat on it necessarily. Okay, so also complicating matters is our federal law, Public Law 8272, which most everybody is probably familiar with. And New York follows this for purposes of the income tax, and we'll talk about all the different bases that they have to tax taxpayers. However, on their income tax base, they do employ Public Law 8272. So for those of you who may or may not know what that is, just as a reminder, if the only activities that a taxpayer has in New York is the solicitation of sales of tangible goods, and those orders are approved and shipped from outside New York into New York, then that income would be protected from income tax. So they do follow that, so just keep that in mind. However, it is a very limited exception. It is limited to the sale of tangible goods, and if you're doing anything that would potentially be an unprotected activity, for example, maintaining stock of goods in the state, or providing services, then that could kick you out of any Public Law 8272 protection. So it's very limited. However, it still is alive and well, and New York does use it. Interestingly enough, from an administrative standpoint, New York does provide some examples of activities not creating nexus, which some of these may be surprising to some of you on here, but just a few things to keep in mind. Maintaining cash balances with banks or trust companies, that might surprise some people that that you may have what's considered an intangible in the state. However, the state doesn't deem that to be nexus creating. You can maintain an office in New York by one or more officers or directors. However, those officers or directors cannot be an employee, and obviously that corporation that they are an officer or director of cannot be otherwise doing business in New York through those other activities that I mentioned, employing capital, owning property in the state, et cetera. Also, what's interesting is that taxpayers can participate in trade shows in New York for 14 days or less, as long as they're not doing anything else, as I mentioned. So they do actually have a bright line when it comes to trade shows. Again, keep in mind it's participating in trade shows. So once, let's say, for example, you start selling something at that trade show on the spot, then that can put you into a different category. However, participation for 14 days or less is not deemed to exceed that nexus threshold. So just some things to kind of keep in mind. I think it's kind of nice that they do provide some examples. However, and these are not all inclusive, of course. However, we just have to be careful on not hanging our hats on some of these, and being careful about what our activities are and how they may or may not meet these examples that are on this page. Okay, so that's going to bring us to our next polling question. So for income tax purposes, the state of New York does not follow Public Law 8272. True or false? Oh. Answer is false. They do follow it. Okay, so now we're gonna just jump into the corporate tax regime, and I'll talk about pass-throughs in a little bit, but Some of you, like I said at the outset, might be familiar with some of these tax bases if you've, if you've done business in New York or filed New York returns. Some of you may be familiar with what used to be subsidiary capital base, and I know that in my experience reviewing and preparing New York tax returns, these returns can be, and used to be, I would say, more complicated. When they did pass the legislation a few years ago, they did ease up on a few things. However, they still have a lot of nuances, and so I just want to touch on these so that nobody's surprised. So 3 different tax bases, used to be 4, now they have 3, business income base, which is the net income base, capital base, and then the fixed dollar minimum, and we'll talk a little bit more about each of these. So business income base, like I said, the net income tax base. So when we were talking about Public Law 86-272, this is the base that would potentially apply to, depending on your situation. New York has a whole slew of different tax rates that will apply, and not only for the business income base, but for the other bases that I'm going to talk about as well. For qualified New York manufacturers, they have qualified emerging technology companies and small businesses. These are all defined and very specific taxpayers in New York. So generally speaking, most of the rest of the population and the rest of the taxpayers out there that are just kind of general C corporation taxpayers doing business, they fall into the last category at 6.5%. Just for your information, a qualified emerging technology company is actually a company that does a lot of R&D in New York, and they have total product sales of $10 million or less. There's some other rules around that, but some examples could include computer integrated manufacturing, robotics equipment, microprocessors, medical and scientific instruments. So again, very specific, and a qualified New York manufacturer is also very specific. And then on the capital base, so the capital base is kind of what it sounds like. Basically, you're looking at your assets less your liabilities, so your net assets, and then you're going to apportion that and then take it times the tax rate. A quick note, though, is for what could comprise business capital is that you could have to include loans to a subsidiary if the sub is actually allowed to take an interest deduction for purposes of the New York franchise tax. So basically, they're just saying that they don't believe that loan is really more equity, and so therefore they want that amount of the loan to be included in the capital base. Again, depending on what type of entity you are, you could have a different rate. They have all these different rates all over the place, and so for our manufacturers and our qualified emerging technology companies, that's one thing. For all other taxpayers, again, kind of skipping to that third bullet down, for most of the rest of the population, the rates are actually fairly low. And then just a note on small business taxpayers at the bottom, small business taxpayers, these are, again, this is a defined term. They're actually exempt from the capital base tax in their first 2 years. But what is a small business taxpayer? Maybe this could maybe apply to you or your clients, but you'd have to have entire net income, which is basically your New York adjusted income of less than or equal to $390,000. You would have to make sure that your equity is not in excess of $1 million. You'd have to have full-time employees of 100 or fewer, and then not part of an affiliated group as defined under the IRC. So again, very specific. However, we do have taxpayers out there that do apply or do qualify for this, and so it's good to know that there are some additional tax breaks that New York does provide for certain taxpayers. And then the fixed dollar minimum. So basically, the fixed dollar minimum is based upon, and it's on a scale. It's basically based upon your New York receipts. So if your New York receipts range from 100,000 to over $1 billion, then your fixed dollar minimum could be $25 to $200,000. I'm going to talk a little bit more about S corps in a bit when I talk about pass-throughs, but they have a different scale, and so their New York receipts, the rates are just a little bit different than C Corp, so something to keep in mind. Again, they have some different fixed dollar minimums, depending upon whether you're one of the qualified emerging technology companies or a New York manufacturer, and then they have some special rules around if you're a captive or a captive REIT or a captive RIC, and what your fixed dollar minimum would be for that. Interestingly enough, they also have certain taxpayers that might be in what they call innovation hotspots, and they may only have to pay the fixed dollar minimum. And to be in an innovation hotspot, you have to be certified by the state, and there's a whole bunch of other qualifications. But again, just back to my point that New York does provide some breaks depending upon your industry and how big you are. And so it's just something maybe to keep in mind if you are going to enter the state and and you are in a certain type of industry. Okay, I mentioned S Corp having a different base or graduated scale. So here's what that looks like. I'm going to talk a little bit more, like I said, about just kind of S Corp taxation in general, and when I get to pass-throughs. But suffice to say that their fixed dollar minimum thresholds are a little different. Okay, and so some of you may also be aware that if taxpayers are doing business in what is termed the Metropolitan Commuter Transportation District, that there's what's termed the Metropolitan Transportation Business Tax, or this MTA surcharge, that's in addition to the other tax bases that I mentioned. So this MTA surcharge, the rate is 28.3% for 17, and then it jumps to 28.6 for 2018. Don't expect that rate to change, however, just you never know. And then the base of the MTA surcharge is the New York State tax before credits. Primarily the same NEXUS standards apply to the MTA surcharge as they do for the state, including the $1 million receipts threshold. If you were wondering whether the MTA surcharge may apply to you, this Metropolitan Commuter Transportation District includes the counties of New York, Bronx, Kings, Queens, Richmond, Dutchess, Nassau, Orange, Putnam, Rockland, Suffolk, and Westchester. So it very well could apply to you if you're doing business in New York. The other caveat here is that do not get this MTA surcharge confused with the New York City tax. That's completely different and could also apply. And we're only talking about New York State today, so just suffice to say that don't forget about New York City, because it very well could apply to you. Okay, now on to our next polling question. What is the current corporate income tax rate for regular C Corp taxpayers in New York? All right, yeah, the majority got it right. This was almost a little bit of a trick question, so I apologize, but 6.5% is correct. Okay. I'm going to go quickly over combined reporting, because New York is a mandatory combined reporting state if you've got taxpayers who are engaged in a unitary business, and it's a water's edge combined reporting. They have some carve-outs for who's included and who's excluded. Typically, if you're taxed under a different article, then you would not be included in a combined return. And Article 9 and Article 33 are specific taxpayers that fall under Article 9 and Article 33 are specific. So Article 9 would include like transportation companies, utilities, telecoms. Article 33 is insurance companies. So those are taxed under something else. They pay a different tax, so therefore they're not part of would not be part of a unitary group. And then some of you may be familiar with how over time New York they were not mandatory unitary, and then they changed their regime a little bit several years ago. And one of the things that they really honed in on, and they typically still do for purposes of unitary, are substantial intercorporate transactions. And basically, when you're trying to determine whether you're unitary, some of these items that I have on the slide here would be what they would look at to determine whether you're unitary. And a lot of it is just what are you doing with your related companies in the group? You know, are you selling goods back and forth? You know, are employees performing services on behalf of each other? Do you have common facilities? Are you transferring assets, including accounts receivable, trademarks, et cetera, between companies? And then they also look at, are taxpayers actually engaged in the same or related lines of business, which is fairly common for our unitary states. But this is not an exhaustive list of what they look at to determine whether you're unitary, but these are just some things that they definitely highlight in their regs and in their statutes that they look at to determine unitary. From an apportionment standpoint, New York is a single sales factor. Laura introduced TPP earlier, and that's tangible personal property. Typically sourced to destination. New York does not have a throwback rule, so if you're not taxable in a jurisdiction in which the items are shipped, then it doesn't have to come back to New York. Sales of services are typically sourced to where the benefit is received, which means a lot of different things to a lot of different states, but they tend to view it as where that service is delivered, and then if that's in New York, then that would be sourced to New York. Similarly, for sales of digital products, interestingly enough, they have a special rule on that if the customer's primary use and location of that digital product occurs in New York, then that would be sourced to New York. Again, location where the digital product is received. So that's what they typically look at. And if that occurs in New York, then that sale of the digital product would be sourced to New York. A couple notes about pass-throughs. We do have a situation where they are, particularly for our partnerships, our limited partnerships, our limited liability partnerships, our LLCs that are taxed as partnerships, they have an annual filing fee, which looks a lot like the $6 minimum tax, and it is based upon your New York gross income, so whatever you've sourced in New York, and again, on this graduated scale here. So don't forget that our flow-throughs are subject to this fee. A couple notes about S-Corps. There is a separate S-Corp election in New York. That's not typical for all the states, but please don't forget that New York does have a separate S election, and they have some specific rules around it, that a corporation may elect to be in New York S only if it meets these qualifications. That, again, has to be a federal S-Corp already, so that makes a lot of sense. The corporation is an eligible corporation, and then all of the corporation shareholders have to agree to make the New York S election. That election is due on or before the 15th day of the third month in the year the election is to apply. So if you wanted it to be effective for 18, it would have been due 3/15 if you're a calendar year. If that election is not accepted or it's not made, then that S Corp is taxed as a regular C Corp. So this sometimes can be surprising for some of our taxpayers out there. There are some limited circumstances where retroactive elections can be made. We have lots of taxpayers that we help even do voluntary disclosures in New York, and that's one of the things that you can do is you can go back as part of the VDA process and be an S for New York if you're an S for Fed. And then I mentioned earlier, but if you are a valid New York S Corp, you've made that election, then you're subject to the $6 minimum, and I had mentioned that in a few earlier slides. So just want to make sure everybody's aware about that S Corp election because that can be missed. And again, now we're on to our next polling question, which is New York imposes which taxes on pass-through entities? The fixed dollar minimum, an annual filing fee, all of the above, or none of the above? And keep in mind that this says pass-through entities, so that includes everybody. And I know we're running out of time, and I just want to mention something about tax reform because New York has enacted legislation. As most of you are probably aware, it's the states are trickling in on what they're going to do with this, and the guidance is sometimes good, sometimes bad, but or not necessarily good and bad, but it's sometimes clear, sometimes not so clear. And New York has enacted legislation to decouple from the standard and itemized deductions on the personal side, and then they also have expanded the definition of exempt CFC income. So if you've got income coming in that's 965 related, it's possible that you may not have to include that in taxable income and get taxed on it. So just keep that in mind. That is something that we're following. And on our polling question, majority everybody got it right, 70%. That's all of the above. So I'm going to now turn it over to Jennifer, who's going to quickly talk to us about closing out a business.
All right. Excuse me. Thank you, Stacy. Just really quickly, just wanted to touch on a couple things. Basically, the steps are about the same. If you're going to, no longer going to be doing business in the state, and really what that means is, not only would you not have employees there anymore, you truly are not doing business in the state anymore. You're not planning to have any activity in the state, not planning to make sales to customers in the state. So if that is truly your case, we want to surrender the authority to certificate of authority, excuse me. Make sure that all outstanding tax returns, tax liability, everything is paid, including any penalties, any interest. Make sure that everything is paid and submitted into the state. There is a form that is the surrender of authority for foreign corporations, if that is applicable, the TR 193.1. And once you submit everything into the state will actually provide a written response. They will provide a written consent saying that everything has been filed, everything has been paid, and the entity is, now can be withdrawn from the state or can no longer be transacting business. Their certificate of authority is no longer valid, and so that certificate would need to be destroyed. But just keep in mind that until you get that written notice, you still are technically registered. And one thing on the sales tax side, to keep in mind that even if you've ceased doing business, but you are still registered with the Department of Taxation, you must continue to file your sales and use tax returns until the business is officially discontinued. And that is even if you don't have any taxable sales or you don't owe any tax, there's still that requirement to file the return. So if you haven't, those would be outstanding and there could be some penalties for that. So just wanted to quickly touch on that. And I think with that, we will wrap up our presentation. So on behalf of Stacy and Laura and myself, I want to thank you all for joining us today. I hope that you've gotten some good information on New York. And if there are any questions, I think, Tara, we can open it up for questions now, or if you've, our contact information should be included here. And if you feel free to email us if you have any questions after the presentation.